Hi everyone. Today, let's talk about an ETF with an annualized return close to 15%. Yes, you heard that right. This is a 20-year track record, and it's nearly 5 percentage points higher than the S&P 500. Beating the market over such a long period is rare for any ETF. That fund is VGT, the Vanguard Information Technology ETF. So, could this be the one to hold for the long run? Let's find out. First, the basics. VGT was launched back in 2004, so it has a history of over 20 years. It's managed by Vanguard, the company that literally invented index investing. The expense ratio, just 0.09%, extremely low, which makes it very friendly for long-term investors. Its assets under management are close to $100 billion, ranking among the largest ETFs. So, VGT is not only popular, but also quite reliable. Now, let's talk performance. Does it really live up to the hype? If you had invested $10,000 in 2005, today it would be worth about $174,000. If you had put the same money into the S&P 500, you'd only have about $76,000. Annualized, that's 14.91% for VGT, compared with just 10.4% for the S&P. In its best year, VGT gained 61.89%, way ahead of the S&P's 32.31%. Of course, we need to talk about risk. Over 20 years, VGT had 153 months of positive returns, slightly fewer than the S&P's 164 months. Its worst year was 2008, when it fell 42.81%. The maximum drawdown was more than 50%, basically cut in half. So yes, VGT runs faster when markets are up, but it also falls harder when markets are down. The difference is, VGT bounced back much quicker. It took just 23 months to recover, while the S&P needed 37 months. In other words, sharper drops, but faster rebounds. But what if you just bought it randomly and held it for a few years? Over the past 20 years, a 3-year holding period could have lost you as much as minus 13.65%. But if you held for 5 years, you basically never lost money. The worst case was still a plus 1.82% return. That tells us short-term pain is possible, but long-term holding pays off. So why has VGT been able to beat the market? It tracks the MSCI US Investable Market Information Technology 25/50ths Index. Simply put, it buys US tech companies across software, hardware, and semiconductors, covering large, mid, and small caps. The index is weighted by market cap, so big players carry more weight, but with limits. No single stock can exceed 25%, and all stocks above 5% can't together exceed 50%. That way, it avoids becoming just an Apple and Microsoft fund. Take a look at the top holdings. NVIDIA at 16.7%, Microsoft at 15%, Apple at 13%, followed by Broadcom and Oracle. These are the giants driving the US stock market higher. Technology has been the engine of US growth over the past decade, and with AI and digital transformation, that momentum could keep going. The index design ensures that the strongest companies keep leading the portfolio. To sum it up, VGT offers ultra-low fees at just 0.09%, 20-year annualized returns of 14.9%, beating the S&P by a wide margin. Focused exposure to the tech sector, capturing long-term growth, higher risk, but also stronger long-term rewards. With AI and digital technology spreading across industries, information technology is likely to keep reshaping the world. That's the core reason VGT may continue to outperform. If you're looking for an ETF to hold long-term, one that could very likely beat the market, VGT deserves a spot on your watch list. So what do you think? Can tech keep leading the next decade? Share your thoughts in the comments, and don't forget to like and subscribe. Together, let's keep searching for those buy once, hold forever investments.